Stop looking at the price tag for a second. If I told you there was a network that just did a 10x in daily active users in under 30 days, had surpassed 1 billion total transactions, and saw institutional capital grow by nearly 1,000% year over year, you would probably guess the token was trading at all-time highs. You would assume the chart was vertical, but you would be wrong. The asset is Avalanche. The price is sitting around $10, and the market is completely asleep at the wheel. We are witnessing one of the most aggressive divergences between price action and fundamental reality in the entire crypto market right now. The retail crowd is chasing meme coins on Solana, while the smart money, and I mean the real smart money, like BlackRock, is quietly parking $500 million on the C-chain. Today, I'm going to show you the data that proves why this $10 level might be the biggest bear trap of 2026. I'll break down the on-chain metrics that are screaming accumulation. I'll show you the exact technical structure on the weekly chart that has played out twice before with massive results. And I'll share my personal game plan, where I'm buying, where I'm placing my stops, and where I plan to take profit. Let the data speak. The price has been chopping around $10, bleeding out slowly against Bitcoin and struggling to reclaim the 21-week exponential moving average. It's painful. I get it. Holding an asset that refuses to move while others were running is the hardest psychological test in investing. Most people look at the chart and see a dead project. They see a token down significantly from its highs. But as a sophisticated investor, you need to look under the hood. You need to ask yourself, is the price down because the network is dying, or is the price down because the market is inefficient? I have been analyzing the on-chain flow for the last 48 hours, and what I've found is startling. While the price has been stagnant, the engine room of Avalanche is running hotter than it was during the last bull run. We are seeing a complete disconnect. Usually, price leads narrative, but in this case, the fundamentals have sprinted ahead, and the price has been left at the starting line. This creates an asymmetry, a coiled spring. But to understand the magnitude of this setup, we have to look at who is actually using the network, because it's not just retail traders anymore. Let's start with the hard numbers, because numbers don't lie. If you look at the developer activity rankings from Sentiment, Avalanche is currently ranked number 3 in the entire industry for real-world asset development. It's sitting right behind Hedera and Chainlink. Think about that. The hottest narrative in crypto right now is tokenization, and developers are flooding into Avalanche to build these products. They are not building on the flavor of the month hype chains. They are building here. And this is not just code commits and GitHub pushes. It's translating into real liquidity. According to Masari, the real-world asset TVL on Avalanche increased by 68% quarter over quarter. But zoom out a bit further. Year over year, that number is up 949%. That is nearly a 10x increase in sticky institutional capital. This growth was driven largely by BlackRock issuing $500 million in tokenized assets through its Boodle fund. We also saw major moves from FIS with their tokenized loan pools. This is the difference between mercenary capital and settled capital. Retail traders buy a token to sell it 10 minutes later for a quick flip. BlackRock and FIS are building infrastructure for the next decade. When they move $500 million on-chain, they are not planning to rug pull next Tuesday. This could validate the thesis that Avalanche has won the enterprise blockchain race, certainly is securing the plumbing of the traditional financial system. But it's not just the suits who are here. The network usage is exploding on the retail side too. Look at the daily active users on Token Terminal. For months, this metric was flat, hovering around 30 to 60,000 users. Then, in mid-January, it went vertical. We are now seeing 612,000 daily active users. That is a 10-fold increase in under a month. This correlates perfectly with the network surpassing 1 billion total transactions on the C-chain. That's a massive milestone. It proves the network can handle load at scale without breaking. And despite this massive surge in usage, the transactions per second have remained steady around 30.5. The network is utilized, but it is stable. Now, here's the economic kicker. Avalanche burns all transaction fees. They don't go to validators, they are deleted from existence. As of right now, over 5 million AVAX have been permanently burned. So, put this together. You have a massive spike in users driving more transactions, you have institutions locking up supply in RWA vaults, and you have a burn mechanism that deletes supply every time the network is used. Supply is shrinking, demand is expanding, and yet the price is sitting at $10. This is what we call a fundamental divergence. And historically, these don't last forever. Finally, the narrative winds are shifting. For the last 2 years, the market was obsessed with Ethereum Layer 2s, but we are seeing a rotation back to the app chain or subnet thesis. Influential voices are realizing that fragmented liquidity on Layer 2s is a nightmare. Avalanche's architecture, which works in production right now, solves this. As the market realizes rollups were a temporary band-aid, capital will likely rotate back to the integrated sovereign chain model that Avalanche pioneered. Now let's pivot to the charts. I'm looking at AVAX on the weekly time frame. This is where the noise filters out and the real market structure reveals itself. The first thing you'll notice is this massive falling wedge pattern marked by the orange dotted lines. This structure has been dominating the price action since the 2021 highs. We are currently trading right near the bottom support of this wedge. Context is key here. We have seen this exact setup play out twice before. Look at the white circles on the chart. In 2021, price compressed into a similar structure, touched the bottom trend line, and then exploded for a 1,460% rally. Then again, in 2023, we saw another compression, a retest of support, and a subsequent 650% move to the upside. We are now sitting at that same decision point for the third time. Price recently tried to break out. 6 weeks ago, we saw a push above that white descending trend line, but it was rejected harshly at the 10-week exponential moving average. The market flushed, and we are now retesting the lows. We have lost the support at $11.50, and we are trading below the 10, 21, 55, and 100-week exponential moving averages. I won't sugarcoat it. That's objectively bearish momentum. The trend is down. However, trading is about identifying when a trend is exhausted. If you look at the Heikin-Ashi RSI indicator at the bottom of the chart, we are seeing a textbook bullish divergence. The indicator has bounced off the -30 region and is making higher lows, while the price is making lower lows. This tells me that the selling pressure is drying up. The bears are running out of ammunition. We are also sitting right on top of a major historical support zone. The $8.50 level was the capitulation wick from October 2025, and it aligns with the lows from 2023. This is the line in the sand. If we look at the Fibonacci levels anchored from the September highs of $36 down to the October lows, our upside targets become clear. The 236 level is at $15. The 618, the golden pocket, is sitting up at $25. So, we have a price compressing into a multi-year support structure, a bullish divergence on the momentum indicators, and a fundamental backdrop that is screaming growth. So, how do we trade this? I'm approaching this with a long-term accumulation mindset. I'm not trying to scalp a 5% move here. I'm positioning for a 6 to 12-month swing. My load zone is strictly between $7.50 and $11. This green box on the chart represents the value area. As long as we are inside this wedge support, I'm a buyer. I believe the risk-to-reward ratio here is one of the best in the market. You are buying distinct support with invalidation very close by. Speaking of invalidation, my stop loss is clear. If we get a weekly candle close significantly below the falling wedge support, let's say a close below $7, the structure is broken. At that point, the falling wedge is no longer valid, and we could be looking at a much deeper flush. I would cut the position there to preserve capital. But if this structure holds, the upside is asymmetric.
I have set dynamic take-profit targets based on key resistance levels. My first target is $15. This is the 236 fib level and previous support turned resistance. My next targets are $20, $30, $50, and my final moonbag target is $80. My strategy is to trim the position heavily, about 30%, once we hit that third target around $30, because that's where we'll likely meet the resistance of the upper trend line of the wedge. I'll be using a trailing stop strategy. Once we hit target 1, I'll move my stop loss to my average entry price. This makes the trade risk-free. If we hit target 2, I move the stop loss to target 1. This locks in profit as we climb. I'm allocating around 3% of my total crypto portfolio to this trade. It's a high conviction play, but I'm keeping the majority of my capital in Bitcoin and Ethereum for stability. The market is giving us a rare opportunity. The price of Avalanche is priced for failure, but the on-chain data is signaling massive success. The disconnect between price and value is at an extreme. I'm betting that the fundamentals will eventually drag the price upward. The falling wedge is a bullish reversal pattern, and we are buying at the point of maximum financial opportunity. It might be boring right now, and it might be scary to buy when everyone else is bearish, but that is usually where the money is made. If you found value in this deep dive, hit the like button and subscribe. It helps me keep bringing you the data that the herd is missing. Remember, price pays the bills, but data tells the story. If you want to see my daily updates on this trade and see exactly when I pull the trigger on more buys, check the link in the pinned comment to join the free Telegram group. And if you missed my last breakdown on the VanEck ETF approval for Avalanche, you should watch that video next. It gives even more context to the institutional thesis. None of this is financial advice. I'm just a guy looking at the charts. Stay safe, manage your risk, and I'll see you in the next one.